Today we are going to discuss the last part of the budgeting series and quite an important one, debt. When we talk about debt, the first thing that comes to my mind is actually a funny joke. Consider this: you may have enough credit to buy an entire jet plane right now, but unfortunately, you may not have enough money to buy a plane ticket even right now. This is the contradiction presented by debt. Debt refers to the amount of money or resources that one individual, company, or government owes to another individual, company, or another government. In other words, it is an obligation to repay money that has been borrowed or a service that has been received. Debt can take many forms, including loans, credit card balances, mortgages, and lines of credit. When one takes on debt, they typically agree to pay back the amount borrowed plus interest and any additional fees or charges. Failing to make payments on debt can result in penalties, damages to credit scores, and even legal action. So, let's look at an example to understand this better. Say you want to buy a new dress that costs around rupees 5000, but you don't have enough money saved up to pay for it. You might ask your friend for the money, which would mean that you now owe your friend rupees 5000. This is a very simple example of debt. Now, speaking more realistically, let's say that the friend agrees to lend you the money, but they also charge an interest at a rate of 10%. The first thing you would say is, what kind of friend is this? Well, that friend can be called a bank. This means that you will need to pay back rupees 5000 plus an additional rupees 500 as interest. That is a total of rupees 5500. Now we shall see a few common types of financial products that people use to manage their finances and make purchases. Number one are credit cards. Credit card is a tool that allows the user to make purchases on credit, meaning the money that you just spent right now isn't yours, but you have borrowed it from the card issuer. You will be required to pay back the amount you borrow plus interest and any other fees associated with the card. Credit cards can typically have a credit limit, which is the maximum amount you can borrow on the card. Credit cards also have a payment cycle where the expenses you make in a month on the card, for instance, have to be paid on a certain date each subsequent month. It's important to use credit cards responsibly and only pay for what you can afford to pay back to avoid accumulating high interest debt. Number two, mortgages. A mortgage is a loan used to purchase a home or other real estate property. Mortgages are typically offered by banks or other financial institutions, and they are secured by the property you are purchasing. This means that if you are unable to make your mortgage payments, the lender may foreclose on the property to recover their investment. Mortgages typically have a fixed or adjustable interest rate and a set repayment term, such as 15 or 30 years. When you make your mortgage payment each month, a portion of that payment goes towards paying down the principal, that is the amount you borrowed to purchase the property, while the rest goes towards interest and any associated fees. It's important to carefully consider your budget and your ability to repay the mortgage before taking on this long-term financial commitment. Lastly, we'll look into loans. A loan is a type of financial transaction where a lender provides funds to a borrower in exchange for repayment of the principal amount plus interest over time. Unlike mortgages, no physical asset is involved here. Loans can be used for a variety of purposes, such as buying a home or a car, paying for education, or even consolidating debt. Here are some common types of loans. Number one, personal loans. Personal loans are unsecured loans that are not backed by any collateral. They are typically used for a variety of purposes such as medical expenses, home renovations, etc. Number two, mortgages. As explained earlier, these are specific kind of loans for buying property. Auto loans. These loans are used to purchase a car, a truck, or any kind of a vehicle. They can be secured or unsecured depending on the lender and borrower's credit worthiness. Number 4, student loans. Student loans are used to pay for education expenses such as tuition fees, books, and other living expenses. They can be government backed or be provided by private lenders, and they typically have longer repayment terms than other types of loans. Number 5 are business loans. Business loans are used to finance the operations of a business. They can be used to purchase equipment, hire employees, or expand the business. They can also be secured or unsecured and can be provided by banks or credit unions or other lenders. These are just few of the most common types of loans. There are also other types which include payday loans, bridge loans, and lines of credit, but we don't need to get into it right now. Remember, it is important to carefully consider the terms and conditions of any loan before applying and to only borrow what you can afford to repay. While debt can be a useful tool for financing purchases or investments, it is crucial to be aware of its potential risks and downsides. Become aware of these risks and manage your debt responsibly. This might mean creating a budget, which brings us back to the focal point of this series. So, to summarize the entire series, a good budget will keep your financial health sound and make you financially responsible. If you have liked this video, then do not forget to drop a like. To know more about finance and see more such informative videos, do subscribe to Spring Money. This is Rohit and see you in the next one.